Good afternoon, and welcome to our partner webinar series, Shaping Tomorrow's Portfolios, the New Frontier in Private Markets Investing. And special thanks to our partner, Meketa Capital, and presenting today's webinar. I want to mention a couple of upcoming chapter events. We've got our Member Appreciation and Holiday Social on December 12th from 5:30 to 7:30, and our quarterly meeting, Income Tax and Estate Law Updates, on January 10th from 8 a.m. to 10 a.m. Check our website for details and register today. We're thrilled to be joined today by Michael Bell, Chief Executive Officer, Meketa Capital. Michael has more than 25 years of experience in the investment management and wealth management industries. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, I'll turn it over to Michael to begin.
Awesome. Thank you, Kathy. Really appreciate the FPA of Georgia for putting this on and for having us as part of the presentation today. So as financial advisors, we know kind of the demands that you have for more sophisticated and diversified portfolios, and that's continuing to grow, right? And because investors today, they're not just looking for returns, but they're seeking ways to access opportunities that maybe they haven't had the opportunity to access in the past. Maybe investment opportunities that have been reserved for institutions or private market investment opportunities. And private market investments and co-investments in particular have really begun to emerge as really a powerful way to meet the demands that we're seeing from investors. And it really offers a unique path to investing in kind of high quality private market investment opportunities, many times with reduced fees, increased control, and the potential to maximize returns. So the thing that we really want to explore today is the distinct advantage that private market investments have in today's kind of investing landscape, and maybe co-investments in particular, and how they provide opportunities to reduce fee burdens, enhance overall selectivity in investment and exposure, and we'll also discuss the nuances of the private market landscape overall and how financial advisors can effectively navigate and deliver that value to your clients. So our goal, for this session is to leave you with a deeper understanding of how private market investments, and maybe in particular co-investments, can complement client portfolios and provide more competitive, resilient investment options in today's market environment for you as financial advisors. So we encourage you to ask questions throughout this discussion today. Put them in the chat below, and we will try to pick up all of those questions towards the latter part of the presentation. So let's go ahead and dive in and get started. As Kathy mentioned, I'm the CEO of Meketa Capital. We are the wealth management subsidiary of Meketa Investment Group. Our objective at Meketa Capital is really to help financial advisors really be your guide to the private markets. We try to accomplish that through providing access to some of the most challenging investments, that have been sourced over decades-long relationships with some of our highest conviction private market investment opportunities. We provide expertise that we've gathered over 5 decades of investing, with some of the largest investors in the country. And we try to provide efficient execution for you and your clients through easy, client-friendly interval fund structures. So to give you some perspective of Meketa Investment Group, our parent company, Meketa has almost 5 decades of investing expertise across the institutional consulting space. We have about 250 employees across 7 offices across the U.S. and London. We manage or advise on almost $2 trillion of assets. And most of that is for institutional clients, like CalPERS and CalSTRS and some of the biggest pension funds and endowments in the country. We have almost 3 decades of experience in investing in private markets in particular. And those are, again, across some of the largest institutional investors in the country. We started with real estate, private real estate in 1994, and we quickly added private debt, private credit, private infrastructure, private equity as well. And it gives you some sense of kind of the breadth and depth and scope of what we do. So just in general, kind of to start the conversation, why do individuals, or why would financial advisors want to look at private markets? What are the benefits of investing in private markets to begin with? So private markets overall, that they offer diversification benefits. Generally, private market investments provide exposure to assets that often behave differently from the public markets, and it really enhances your overall portfolio diversification. Most of the private market assets have a potential for higher returns. Historically, private investments, particularly private equity, have generated higher returns than public market counterparts, due in part to factors like operational improvements, longer investment horizons, and less liquidity kind of in those private vehicles. Private investments also give you access to unique opportunities. Private markets, include a broad array of assets, from private equity to private debt to private real estate to private infrastructure, that are largely inaccessible to the public. So in many private markets, investment exposure gives you really kind of a structural hedge against inflation. Real assets, infrastructure, and real estate can offer that type of hedge that you typically don't see kind of in the overall in the underlying public markets. So generally, kind of across the spectrum, that's what you see kind of with private markets. The other aspect of private markets is reduced volatility kind of across the board. And the reason for that is that the investments, even though they're priced and they are incorporated into your portfolio on a daily basis, private market investments don't have the same level of embedded volatility from price movements that you see kind of in public markets. So, Pete, if you want to go back one slide, kind of skipped over that. If you want to go to slide 3, I can kind of go through some of the attributes of Meketa. Okay, great. So yeah, go to the next slide. Thanks. So when you look at kind of Meketa's breadth and depth kind of in the market in general, this is to kind of level set and give you some perspective of what we do. Kind of across the 7 offices, across 250 investment professionals, we look at and we diligence almost 4,000 private funds a year. Okay. And that is including, we do about 3,500 manager meetings over the course of the last 5 years. We do about 3,800 fund reviews over the last 5 years. We're looking at 700 to 800 funds and 700 to 800 managers every single year. That's important because it's a new market that's opening up for financial advisors for the first time. You want to kind of make sure that you have somebody that has a level of expertise that's spent a lot of time kind of in those markets that can really kind of help you kind of walk through that. So maybe the next slide, Pete. So in kind of looking at the differences kind of in the public markets and the private markets, this is a marketplace that really hasn't been open and available to many the private markets investment opportunities haven't really been open to financial advisors except for the last couple of years. And there's reasons for that. There are a lot of operational hurdles in the private markets, and they're fairly difficult to access. The private markets are still, they traditionally have been, what I call kind of a club-like kind of investment environment. You're either in the club and you can invest kind of in that group, and those are largely institutions, endowments, and foundations, or you're not kind of in that group. But the barriers to private market investing are now starting to come down. Okay. And there's structural reasons for those barriers that are coming down. And maybe the best contrast that I can give you is to give you some perspective of what's happened with the public markets. Okay. So the public market investments that you are accustomed to, that you've invested your clients in, whether they're through ETFs or through mutual funds or through direct stock investments, there's been a very significant shift in that market over the last 25 years, but it's happened slowly, so it may not be completely apparent to everybody. That slow shift, what's happened, 25 years ago, we had about 8,000 publicly listed companies in the United States. Today, that number is about 4,000 publicly listed companies in the United States. Over the last 25 years, the market cap of that overall market has also increased from about $1 billion market cap to about $8 billion of market cap. So the public markets have had this degradation. I'll show you a little bit more in detail in a few slides, but have had this degradation kind of over the last 25 years that have really opened up the private market investments. We also have new structures that are available in the private markets that we'll talk about as well. So if you want to move on to the next slide, Pete. We've already talked about kind of this slide, which is really some of the benefits of investing kind of in the private markets and what that looks like and why. And I really wanted to focus on a couple of subsegments of the private markets, particularly private equity and infrastructure. So if we look at private equity first, okay, private companies and private equity companies, particular, they're across all subsectors of kind of the investment landscape, from tech companies to healthcare companies to financials and industrials and consumer discretionary and retail. So across the entire landscape of investing, there are private companies. In fact, there are 6 times more private companies than there are public companies. If you want to go to the next slide, Pete. One of the things that I had kind of mentioned previously was what's happened to the private markets over the last 25 years. If you look at the slide, we've seen this degradation, the slide on the graph on the far right, we've seen this degradation with the light blue line of a movement from about 8,000 publicly listed companies over the last 25 years to just over 4,000 publicly listed companies. At the same time, the market cap in the really dark blue portion of this graph, the market cap of those companies, the average market cap has gone from about $1 billion 25 years ago to north of $8 billion. And so what you're left with, you had 8,000 average billion-dollar companies. Now you have 4,000 average $8 billion market cap companies. Those companies are largely, they're pushing into large cap arena. Okay, what's happened to all the small and mid cap companies? Okay, they haven't gone away. Those small and mid cap companies have now just been capitalized and financed by private equity. Okay, and you can see those 4,000 public companies. They're over there. They in the graph on the right. They represent about 15% of the investable landscape, if you will. Companies that have over $100 million of revenue. There are 85% of the companies out there with over $100 million of revenue are private. That's the pool that you're looking at. The expanded pool of investment opportunities are in the private market arena. And so that's what, when we talk about private equity, that's what we're talking about. We're talking about those small and mid-cap companies that are focused, that are not publicly held. So, one of the reasons that we talked about, maybe if you want to go to the next slide, Pete, one of the reasons that we talked about investing kind of in the private markets is for the potential for those private market investments to outperform, okay, the public counterparts. And so why is that? Why do private companies have the opportunity to perform at a different rate, a different level than public companies? Well, there's a number of reasons for that. And one of the primary drivers for that is the fact that private companies can really look at a very long-term operational focus. Public companies, we know, you see it, you saw NVIDIA today, if you're following kind of earnings come out every single quarter. And so typically public companies, they're looked at and they have a scorecard that investors look at quarter by quarter by quarter and press release by press release. So almost daily, public companies have to kind of manage investor expectations, whereas private companies can really look at long-term, kind of operational focus, because they're not getting that daily scrutiny, that quarterly scrutiny. They're getting daily and quarterly scrutiny by their private equity owners, but they're not getting it from the public market. So they have really a long-term kind of operational focus. Typically, private equity owners also can provide input and have some control over helping their private equity investments grow. So they sit on the board, they sit on the operating committees, they sit on the executive committees, and they provide a vast array of input to the private companies that they own to really help them with strategic decisions, strategic direction, and making kind of better investment opportunities available to those companies. And so also there is a very significant alignment of interest between the private equity owners and the private equity companies that they own. They are all in it for the exact same thing, to really help this company grow and expand. And so when you have that alignment of interest, you have a potential to outperform. And then finally, private equity owners don't have a particularly hard and fast time frame to grow a company or to exit a company or to sell a company. They will do that when the timing is right, when the market is right, when the opportunity is right. So they have flexible exit timing to really enhance the value. That's why those are some of the primary drivers that you see in that. And if you go to the next slide, what that kind of turns into, okay, some of that operational control, that alignment of interest, that flexible kind of timing, you actually see that borne out in kind of the performance results. If you look at private equity kind of on this slide, it's been the top performer of every asset class kind of across the globe. And it's because of those attributes that I just referenced, that I just mentioned. And you can see the level of outperformance that you typically get kind of across the board. Also, you see with private equity, you see kind of lower volatility. And you see lower volatility because you're taking out of the equation kind of the daily pricing that you get kind of in the market. So the next slide, to really put all that together and to show kind of what lower vol does, what increased return potential does, what it does for a portfolio is maybe best described kind of on this slide. So you see your traditional kind of equity fixed portfolios kind of in the gray boxes on the lower part of this slide. When you incorporate some percentage of private equity, because of that increased return profile, whether it's 5%, 15%, or 25%, you see what that does to your overall risk-adjusted return. It really increases your overall annualized return potential. And at the same time, it reduces the overall volatility and the overall standard deviation in your portfolio. This is the best representation of incorporating private equity or private market investments into a portfolio. This is the movement that you would otherwise expect to see, kind of based on, traditional capital market assumptions. So that's kind of an overview of the benefits, the overall asset class of private equity, what it kind of looks like, what it means, and really what are the implications for your overall portfolio. The second asset class that I'd like to talk about is private infrastructure. Now, private infrastructure is very different than private equity in that infrastructure really is embedded in everyday life. Infrastructure are those things that really drive, the underpinning of our lives, okay? Transportation, energy, data, hospitals, medical facilities, the things that you look at, the things that you use every day. When we look at infrastructure, there's generally core and non-core infrastructure. Core infrastructure is a little less volatile and maybe more traditional profile. But when we look at kind of all the transportation needs, if you have traveled recently and you see, bridges going up or metro facilities being expanded, or I've been traveling a ton recently. It seems like almost every airport that I'm in is undergoing some new type of development or expansion. That's infrastructure, kind of in the transportation sector. You see that with traditional kind of energy and utility, whether it's energy generation, power, storage, or overall processing. One of the significant drivers in the uptick in infrastructure today is data. With data centers, satellite cell towers, and fiber optics, you're seeing AI drive a tremendous demand for data and data centers. And so that's driving a lot of the excess demand in infrastructure today. And then obviously you have what we characterize as kind of social or foundational infrastructure, which is hospitals, student housing, courthouses, and other asset classes like that. When you look at this as an asset class, okay, when you look at infrastructure as an overall asset class, these types of investments 20 years ago, 30 years ago, traditionally were made by governments, governmental entities. And then you started to see the investment opportunities move into the institutional arena, the big kind of endowments and pension plans and institutional investors. Now, for the first time, we're able to move this really durable asset class into the retail investment arena for the first time. And so when you kind of look at infrastructure and the overall return series, it's a very healthy return series. This gives you some perspective of kind of core, non-core, core plus infrastructure asset classes, private infrastructure asset classes compared to the U.S. equity markets. Even though you're looking and getting somewhat equity-like returns, a very different asset class. The reason that asset class is different is the traditional returns that are generated from infrastructure are really built off of very long-term contracts. Okay, and those contracts are guaranteed contracts. They have generally inflation hedges, kind of, or inflation kickers built in. And when I say long-term contracts, think of seaports or think of toll roads. Those revenue streams are guaranteed by the underlying toll road manufacturer or cell tower provider for sometimes 10, 20, and sometimes 30 years out. And so very durable asset class, very, very predictable return stream that you get that really drives kind of the returns that you're seeing here as well. And so this gives you some perspective of, maybe upside and even drawdowns kind of in certain markets. You kind of look at the 2008, 2009 drawdown in the market where some of our market indicators were down 40 and 50%. You see infrastructure is not a cyclical type of asset class. It was down, 15%, not 50%. But traditionally, it's very predictable. Return streams gives you some perspective of what it looks like over the last decade or so. Also, in infrastructure, just like the private equity class, you see significantly lower volatility. Okay, it's a very, very smooth asset class in terms of return performance because it's very predictable. And that's what you see kind of on this chart as comparing kind of core, non-core, core plus with the Russell volatility or standard deviation. So maybe kind of the shock scenario, kind of what it looks like with particular kind of market profiles that you're all very familiar with. Look at the global financial crisis to begin with. Again, I referenced earlier some of the asset classes or indices were down, approaching 50%. The core and non-core asset classes in infrastructure were down less than half of that, or sometimes just 20% of that. Going through the COVID crisis, as well as the rate hikes that we just saw, you can see how the traditional U.S. equity market performs kind of versus the traditional asset classes in infrastructure. So this is a similar slide that you saw kind of on private equity. This gives you an example of what happens to your overall kind of investment, overall allocation in a portfolio. The gray boxes at the bottom are your traditional kind of 60-40 mix of just kind of equity fixed income. And then you add in some component of private infrastructure, whether it's 5, 15, or 25%. Again, kind of it moves your overall kind of risk-adjusted return profile up and to the left, decreasing your overall volatility in the portfolio and increasing your overall return profile in that portfolio as well. So maybe kind of touching on some of the current trends that we see, something I kind of mentioned at the top of the conversation, and that is really co-investments. Co-investments are a very exclusive asset class, a very exclusive investment structure in the private investment arena. And I want to kind of give you some perspective of what they mean. You're starting to hear about them more and more. We at Meketa take advantage of co-investments in the investment programs that we put in place, and wanted to make sure that you have an understanding of what co-investments are and what the potential advantages of co-investments are. So there are a couple of different ways that you can get kind of access to private market investments, okay, kind of across the board. And they are traditionally in funds, in fund of funds, or you can get, if you're lucky enough and you have the relationships and you have the access, you can get investments of co-investments. Let me describe kind of what a co-investment is and give you an illustration of that so you can kind of carry that forward kind of over the next couple of slides. So let's just talk about a private equity investment to begin with. Let's talk about maybe a private equity investment that there's a sponsor or a big private equity firm that has been looking at an investment for some period of time. They've been following a company for a couple of years. They want to make an investment in that company. Let's say they're doing it out of their Fund 6, okay? And Fund 6 is a $10 billion fund investing in kind of middle market private equity. That fund traditionally has some structural limitations on it. Not a ton, but it has to invest in middle market. But it also has some limitations so it doesn't get over concentrated. So there may be a structural limitation of saying this fund can invest more than 10% of its assets in any one particular investment, right? So at that point, you have a $10 billion fund. You can't invest more than $1 billion in any one particular investment. Well, this one investment that this fund is looking at, let's say it's $1.2 billion. Okay, so they can actually utilize about $1 billion of the fund's assets to buy that asset, but they're still short by about $200 million. I call that kind of gap financing. They have to go find another $200 million to get that investment closed. What that fund sponsor would do historically, they would pass the hat to their competitors. If this was Apollo, they would go to Carlyle and KKR and Blackstone and say, hey, folks, got a great investment. You want to participate in this? That's how they used to do it. They would ask their competitors. Nobody likes to ask their competitors to help them out to get a deal closed, but they used to. Today, what they traditionally do is ask their largest LPs, their best customers, okay? The people that bring those $10 billion of assets into their fund, the CalPERS and the CalSTRS and the Texas teachers, the big endowments, pension funds, and the like, they ask those LPs, hey, would you like to invest alongside us? We need $200 million. Would you like to participate? You're already in the fund because you've already made an investment in the fund, but would you like to invest outside of the fund right alongside of us? And what's in it for you as an LP, we're not going to put any fees on it. The investment that you made in our fund has a 2% fee and kind of 20% carried interest. Okay, so there are traditional private equity fees on that investment. In the investment that you're going to make alongside of us in this co-investment vehicle, it's going to be free. You're going to help us out because we need capital to get this deal closed. We're going to help you out by giving it to you for free. So it's kind of a win-win for everybody. Okay, that's what a co-investment is. And so the benefits that you get, kind of as you can see on this slide, you get lower fees because traditionally those co-investments are fee-free. All right. So when you look at that co-investment, I'll show you in another slide of how significant that fee reduction is. What you also get as an investor in co-investments, you're putting your capital to work today, right now. You're writing a check for $10 million. It's going into that co-investment today. When you invest in a fund, you may make a commitment for a fund investment of $10 million, and that takes 3 or 4 years for that sponsor to draw down all of those funds and make those investments. That's what's traditionally called a J curve. It takes a good bit of time of drawing those funds to make those investments over 2, 3, 4 years, right? Whereas today you get immediate deployment into co-investments. And then also you get more control over the investments that you make in co-investments. When you go to a fund, you put up $10 million of capital, and it's basically a blind pool, right? You don't know, you have a general offering memo of we're going to invest in these types of companies, but we haven't invested in any. So, but this is what it's going to look like. So it's a blind pool. That's what it's called. In co-investments, you're writing a check today for a retail watch manufacturer or whatever that company may be. You know exactly what you're investing in, and you can pick that investment or you can pass on that investment. So you have much more control in selecting the specific investments that are in your portfolio. The other huge benefit that you get with co-investments is you get a diversification across general partners. Okay, and what do I mean by that? So in a traditional fund, let's use Blackstone. Blackstone will put a fund together, $10 billion fund. You will make your commitment, your $10 million commitment to the Blackstone fund. And what you're going to get in that fund are all Blackstone sourced deals. And they'll go through the Blackstone process, the Blackstone diligence. It'll be all Blackstone all the time. That's what you will get. Okay. And they've done historically very well. Okay. When you get co-investments, you may take one investment from Blackstone, one investment from, sponsor 2 and sponsor 3 and sponsor 4. To give you an example, we have a fund that we have launched, and we've got 25 investments in it, individual investments, co-investments from 23 different sponsors. So we're getting sources of investment opportunities, the best of the best opportunities from many, many, many different general partners. So those are some of the potential advantages that you get with co-investments. So I mentioned this kind of previously, wanted to talk about what that means kind of in terms of, we talked about those co-investments come without fees, no fee or no carry. You're able to sidestep the traditional fund fees, which are what we call 2 and 20. What's that look like? How does that play out? What's that mean for the end investor? Okay, I think this slide kind of best describes that. And we'll go from kind of left to right. In the traditional private equity fund, they carry fees that are that you've heard of the structure, and it's pretty well established, and it really hasn't changed a lot kind of over the last 20 years. It's 2 and 20. That 2 and 20 structure means 2% of an annual management fee up front, and 20% basically of the upside, the profits on selling that investment. There's usually kind of a hurdle rate kind of in there, but to better explain it, we'll just call it 20% of kind of the upside or the profits of that investment. The 2 on capital is generally 2% on committed capital. So in a traditional private equity fund, you'll make a $10 million commitment. And as I mentioned previously, sometimes that may take 3 or 4 years to actually draw all that capital, even though you haven't spent any money or you haven't made any investments on that $10 million, you're still getting charged 2%. So you're getting charged 2% generally on committed capital, not on deployed capital. Very different. So you're paying a fee on money that hasn't even been called yet, hasn't been deployed yet, hasn't been invested yet. So that 2 is actually much more than 2 because it's 2 on committed capital, not called capital. And then the carried interest that you get when private equity firms are kind of doing what they've done kind of over the last couple of decades. They've done incredibly well. That 2% or that 20% carried interest generally works out to be, kind of 400 or 500 basis points. So when you put the 2% on committed capital with the carried interest, you're really talking about 700 basis points of additional fees. And so in the traditional world of private equity, a private equity firm generally has to generate a 25% return at the top level to deliver its LPs an 18% return, because the general partner is taking 2 and 20, which is about 700 basis points annualized kind of over the life of that fund, which may be a decade. So again, many institutional investors have lived with that structure for decades. And they're getting, kind of 17, 18, 19% net returns. Many of them aren't complaining, but the general partner of that fund is getting kind of 24, 25, 26% gross returns, keeping 7% and then providing the net return, really healthy net return to limited partner investors. And then, so that's the chart kind of on the very far left that shows you kind of a traditional private equity fund. Then if you look at a fund of funds, you've seen funds that invest, private equity funds that invest in other funds. That just adds another kind of layer of fees. Those are traditional private funds. The registered funds that many financial advisors are getting exposure to now, they come in a couple of different flavors. You can see these are the two charts on the right side. They come in a kind of a tender fund concept, and those tender funds traditionally have a very high complement of secondaries. You hear secondaries or direct funds. Those secondaries or direct funds are those 2 and 20 funds that are kind of on the far left-hand side, plus the fees that the tender fund needs to incorporate to run the fund, to manage the fund, to source all of those investment opportunities. So what you end up getting in some of those tender funds that have a heavy complement of secondaries or direct investments, you have a very high component of what's called acquired fund fees and expenses, or otherwise known kind of in the mutual fund world as AFF&E. So they can very much stack up and really raise the overall fee load of some tender funds, up in the 800, 900 basis point range. When you look at interval funds that are completely invested in co-investments, as we referenced, those co-investments generally come with no fees. So there's zero acquired fund fees and expenses. And so that benefit really inures to the end benefit of the end investor. And so you're able to the sponsors of those interval funds that have co-investments embedded in them, you're able to deliver greater portion of the return to the end investor, and it's not being held at the general partner level. So anyhow, I want to give you some perspective of kind of what the variability kind of looks like across different private equity investment vehicles. You can see kind of the stark contrast from the far right, interval funds that are only co-investment focused versus others that have very significant incentive fees or performance fees kind of embedded therein. So one of the other, I think one of the most important drivers of making private investments, is not as much as selecting the underlying investment, but selecting the manager of that investment. And why is that important? We know kind of across the public arena, when you look at public large cap growth stocks, for example, the performance difference between the best managers that you have available to you and the poorest performing managers, kind of top quartile, bottom quartile, that may be kind of 300 or 400 basis points. Okay, it may not be. You want to pick top quartile, but it's not hugely significant. Okay, 300-400 basis point kind of performance differential. If you pick the wrong kind of large cap growth manager, it's not going to destroy your portfolio. You'd prefer to pick the best, but it's not going to have a tremendously adverse impact on your overall performance. On the private side, it's a very different story. So on the private side, if you look at the far left hand of the graph, the dark blue bar, the private equity kind of interquartile spread between the top quartile managers and the bottom quartile managers, it's approaching 15%. Okay, so if you select the wrong manager, that can be a very significant impact on your client, sometimes for a decade, because many of those private market investment opportunities are kind of 7, 8, 9, 10 years, locking up your investment for 7, 8, 9, 10 years. And so it's incredibly important to know the managers and to be able to select the right types of managers, those that have traditionally outperformed, Many of those managers in the private market space that have outperformed are closed to new investors. And so you have to have a way to get access to those closed investment opportunities. There are ways to do that. But this is the reason that manager selection is so incredibly important in the private markets arena. Not all managers are created equal. And just because this market's opening up to you, you may not know kind of the nuances of the market. Just focusing on private equity specifically, there are about 6,000 private equity managers that are out there managing funds today. There are about 20,000 funds, private equity funds, that's including venture, but about 20,000 different fund offerings that are available. And so you want to be able to select the top quartile, obviously not the bottom quartile. When you look at that dynamic across all private markets, so call it credit, infrastructure, real estate, and private equity, you're talking about 20,000 managers and about 67,000 products kind of across the entire investment landscape. So a lot of managers, a lot of products out there. You want to make sure that you have the right expert that's really helping you through kind of the private market investment opportunities that you have there. So maybe I'll end kind of with this slide, and we'll save a few minutes for questions kind of at the end. But this slide, a lot of stuff going on here, but really what I wanted to describe to you is kind of the investment process, implementation process with some of those different investment options that we talked about and the level of complexity that's currently involved. So the best way to look at this chart is kind of, down the left-hand side, and we'll start from the bottom and go to the top. So if we start in the bottom left-hand corner, kind of what's called a traditional private market investment structure. Those are traditional private, 3C1, 3C7, traditional drawdown structures. You make a commitment of $5 million today, and that investment is drawn down over the next 3, 4, 5 years. Right? It's generally one manager and kind of one type of investment profile. So the hurdles, these are all these boxes represent hurdles for you as financial advisors and investors kind of along the way. So you traditionally get some very high kind of investment minimums that are there. Because they're high investment minimums and because they're sophisticated products, you generally have accredited investor standards. So accredited or qualified investors are required for these types of investments. So there are investor limitations. There's lots of paperwork that's involved. There's what are called subscription documents. Some of those, we fill out subscription documents on every investment that we make at Meketa. Some of those subdocs are 37 pages, some of them are 87 pages. And that's for every single client, for every single investment you're making. You have to fill out subdocs. Most of those traditional private market investments, they don't integrate on platforms. They're not tradable in models. You kind of make an investment one time, then there are various capital calls over the next 3, 4, 5 years. You generally have K1s. There's zero liquidity. You get liquidity at the end of 7, 8, 9 years. And so it makes it fairly challenging for individual advisors to incorporate these types of investments into their investment portfolio. These are the traditional types of investments that have been kind of reserved for institutional investors that we invest in on behalf of our institutional investors, because of the challenges that are involved. As you go up the stack, kind of the middle part of the slide, you see what I call, technology solutions have emerged that have helped reduce some of those hurdles. Some platforms that are out there that develop feeder funds, that do a little bit of diligence on products, that package products, that bring the minimums down. So even though they bring the minimums down, there's still subdocs. Some of those subscription documents may be automated. So the hurdle's not so high. They've moved it down a little bit. The investment minimums are a little bit lower. Sometimes they allow you to invest on a monthly basis, not kind of one and done, kind of over 10 years. But they still generally offer K1s, so that hurdle's still there. And your assets are locked up for quite some time, 7 to 10 years. So again, the technology solutions, the platforms that are out there, they've reduced the hurdle to private market investing some and made it more accessible to some advisors and clients. And then I think the last kind of category that we've kind of talked about are what are called interval funds and tender funds. And for some of those products, they have not only reduced down the hurdles, they've just eliminated all the hurdles. Like in particular, if you look at interval funds, some interval funds are point, click, and invest solutions. A ticker symbol kind of looks, acts, feels just like a mutual fund, has a ticker symbol. It's on your traditional kind of fund serve platforms at Schwab and Fidelity and Pershing. There are generally no investor limitations on interval funds. There are very low investment minimums, like $2,500 or $5,000. Very traditional low minimums, like traditional mutual funds. There's generally no client paperwork at all. It's point, click, and buy. They're on the traditional mutual fund platform, so you can incorporate them into models and trade them into models. And many interval funds you can invest in on a daily basis. There are no capital calls. And then maybe a big benefit for your end clients for interval funds, you've now switched from K1 treatment kind of into 1099 treatment, the traditional treatment that you get on most kind of mutual funds. There are liquidity features. So you go from 7 to 10 year kind of lockups to traditional interval funds offer quarterly liquidity. There are usually some limitations on that, like 5% of the fund's NAV on a quarterly basis. You have some of those invest in some investment types that have really reduced fees, like we talked about on the co-investments. So that's kind of the evolution, kind of the access to private markets. Started at the very bottom with some significant hurdles. We've had technology that's reduced some of those hurdles, and then some product structures that have even eliminated those hurdles. So hopefully that gives you some perspective of private markets, a little bit of a deeper dive into private equity in particular, as well as infrastructure specifically, and wanted to help provide some additional education on co-investments kind of within the private market structure. So I know we have kind of a couple of questions, and we have a few minutes for those questions. So Julian, if you've had a chance to maybe kind of look at those questions, do we have any that are in there at this point?
Yeah, we sure do, Michael. We have two questions, and thank you for participating today. So the first question is, in your opinion, is there a good place to start with clients who aren't very familiar with private investments? For example, private debt versus private equity infrastructure versus real estate.
So I think across the board, most of those asset classes are opening up to financial advisors and clients. We have, as we kind of gone through this conversation, you have not really heard me talk about alternatives, because these things that used to be called alternative investments are now becoming very mainstream. There's this mega trend shift. The mega trend shift was led by private credit, okay? And really some of the private credit providers have replaced some of the traditional bank financing vehicles that have been out there traditionally. So you've seen a significant influx of new private credit investment opportunities. That's been followed by, there's a very healthy complement of private real estate that's in the market. That may be something that may be a little bit more familiar to most of your clients. And then we see kind of third opening up, private equity has now become, with a couple of dozen, maybe 3 dozen new product offerings that are available to retail clients. And then I think the asset class that is maybe one of the harder ones to open up to retail clients has been infrastructure. And so you see a handful, maybe 4, 5, 6 investment opportunities in that arena. So, but in terms of starting with a client, it's really the conversation of expanding your investment opportunity. When we saw from the earlier slide, only 15% kind of the investable marketplace is currently public. There's 85% of that investable marketplace in equities that's currently only available in private equity. So you're really expanding your investment profile. You're expanding your diversification, lowering your volatility, increasing your potential return profile. So it's a conversation that's being had across the industry, from asset managers that are manufacturing the product, to investment advisors, to end clients. We're seeing that happen frequently across all asset classes.
Thanks, Michael. And the second question is, it seems that everyone is rather bullish on deal flow opening up substantially in 2025, given the upcoming change in administration. What is your view on this, and how do the recent rise in yields come into play here?
So in terms of deal flow and deal sourcing, I can just give you the experience that we've seen. So I think across the overall industry, when I talked about 20,000 private market managers and 67,000 private market investment opportunities, that includes managers that are in the top quartile, managers that are in the bottom quartile. You take all that together and you get a headline that says, deal opportunities are down or deal opportunities are moving up. I can tell you from the Meketa perspective, our investment sourcing pipeline has been incredibly robust over the last several years. So we haven't seen a real downtick in that. But we are only dealing with kind of the top performing managers that we've known. Again, we look at 800 to 900 managers a year, and we review them. We look at 800 to 900 individual products a year. And so the deal flow that we've seen has been very robust. So we don't see kind of any change. We haven't seen a change in that. Maybe there's an anticipatory change with the new administration that they're going to reduce the regulatory environment or make the investing environment, maybe more tax friendly. That's still to be seen, but the deal flow environment has been for the best performing managers very healthy, and we expect it to continue to be there. The overall interest rate environment, kind of lower interest rates are better for kind of growth type companies, and so the downward trend, the downward tick that we've seen, kind of over the last couple of sessions, over the last half of this year, is obviously very helpful for financing needs. But again, I think the healthiest companies kind of out there and the most prominent investment partners that are out there haven't seen a tremendous change kind of in the investment environment. Has been very robust, and we expect it to continue to be so in the coming years. So anything else kind of in there, Julian, or we just had those two questions?
Just have those two questions, Michael.
I think we're right. We're actually right at the top of the hour. And so I want to thank the FPA of Georgia and Kathy for including us in this. I think the opening up of the private markets is an incredible opportunity for advisors, for new ways to differentiate themselves with their clients. It's a great opportunity for your end clients to get into new diversified asset classes, to see kind of return streams and performance that they haven't seen in the past. It's really been exclusive for institutional investors previously. So it's a great opportunity. But I think to take advantage of that opportunity, you really have to lead with education. And so organizations like the FPA do that in a tremendous way. So we're thankful for the opportunity to provide education. And we have resources around the country to support you and any questions that you have. Kind of Julian will be our point person. Anything that we can help with kind of across the investment spectrum, whether it's, in the private equity side, private infrastructure, credit, or real estate side, we have resources to help, and we'd love to do that. So Kathy, thanks for having us here. We very much appreciate it.
Oh, Michael, thank you. Thanks for your time and expertise and such an informative presentation. Thanks to Meketa Capital again for your partnership. And thanks to everyone who connected with us today. Please look for a post-event survey, which will include the PowerPoint deck along with a webinar replay. And wishing you all a great Thanksgiving. Thanks, gentlemen.
Great.
You too.
Thanks a
Thank
ton.
you.
All right. See you,
everybody.
Bye.
Bye-bye.